You can have money in your account and still not be able to use it. It is a Saturday morning. A man walks to the ATM outside his bank. He inserts his card. The machine returns it. His account is not empty. The bank has not been robbed. 2. But sometime on Friday night, while he was asleep, a decision was made. And by the time he found out, there was nothing left to do. What happened in Cyprus in 2013 was not a crisis in the way most people use that word. It was a mechanism, designed carefully, written into law years before it was ever used, and activated the moment conditions were right. And here is the part almost nobody talks about. That same mechanism exists right now, in the laws of the country where your money is sitting. This is not a story about Cyprus. This is a story about the legal structure underneath every bank account in the modern world. And once you understand it, you cannot look at your savings the same way again. His name does not matter. What matters is what he had. 87,000 euros, 11 years of work, a construction business built carefully, tax paid every year, no debt he could not cover. The money was set aside for his daughter's education and a business expansion planned for spring. He was not wealthy. He was responsible. He had done everything the system asked of him. The ATM gave him nothing. Not because of fraud, not because of his own mistake, because on Friday night, in a closed meeting between European finance ministers and IMF officials, a decision had been made about his money. He was not in that meeting. He was not informed it was happening, and by Saturday morning, when he stood at that machine with his card in his hand, the window had already closed. But the real reason this happened, the legal structure that made it not just possible but inevitable, is not what most people think. And it goes back much further than 2013. To understand Cyprus, you need to understand what Cyprus had become. In the decade before the crisis, its banks had accumulated assets worth 8 times the country's entire annual economic output. 8 times. Most stable economies sit at 1 or 2. Cyprus was not a small island with a big economy. It was a small island with an enormous financial system balanced on top of it, and almost nobody outside that system understood how fragile the balance actually was. The banks had grown by attracting deposits from across Europe and from Russia. High interest rates, light regulation. Money flowed in, and the banks deployed a significant portion directly into Greek government bonds. In 2012, Greece restructured its debt. Cypriot banks absorbed losses of over 70% on those holdings almost overnight. The institutions were suddenly insolvent. The government had guaranteed those deposits, and the government did not have enough money to make good on that guarantee. And this is where it becomes irreversible. The bank loses money. The government cannot cover the gap. Pressure arrives from outside. And the only resource large enough to fill the hole is already sitting inside the system in the accounts of people who had no idea a hole existed. The EU and IMF offered a bailout, 10 billion euros, but there was a condition. Cyprus had to raise 5.8 billion on its own. No reserves to draw on, no time to borrow. And only one place in the entire country where that much money existed inside the bank accounts of ordinary depositors. What followed was weeks of closed-door negotiations. European finance ministers, IMF officials, Cypriot government representatives. The depositors were not at the table. They were not told a table existed. They checked their balances. The numbers were still correct. Nothing on the screen had changed. The system looked exactly as it always had. Stable, normal, safe. On the night of Friday, March 15th, a proposal was placed before the Cypriot parliament. Every account under 100,000 euros would lose 6.75%. Every account above that threshold would lose 9.9%. Every depositor in every Cypriot bank. Applied over the weekend before markets opened Monday. Before anyone could move a single euro. Here is the detail that changes everything. The ATMs were not turned off by accident. Withdrawal limits were quietly reduced before any public announcement. Some machines were emptied and not refilled. The window was closed first. The explanation came after. That sequence was not a coincidence. It was a procedure. The Parliament rejected the proposal, but rejecting it did not reopen the ATMs. The banks stayed closed. The pressure continued. And what replaced the rejected plan was, in one critical respect, far worse. The final solution did not spread the loss across all depositors. It concentrated it. Laiki Bank was dissolved entirely. Bank of Cyprus was recapitalized. And to fund this, deposits above 100,000 euros in those institutions were not taxed, they were converted. Everything up to 100,000 euros remained as a standard deposit. Everything above that line was placed into a separate category. Approximately 47.5% of it was converted into bank shares, shares in a bank that had just been declared insolvent. The rest was frozen indefinitely, with no release date and no appeal process. This was not a fee. This was not an emergency levy. This was the bank reaching into an account, removing nearly half of everything above a threshold, and replacing it with paper whose value would be determined by a market that had already judged the institution worthless. And once this starts, there is no stable outcome. Imagine it is Monday morning in Limassol. You own a small business. You have 200,000 euros in Bank of Cyprus, not personal savings, but operating capital. The money you use to pay suppliers, to make payroll, to survive the slow months. You arrive at work and find that 100,000 of those euros are now bank shares. A portion of the rest is frozen, with no timeline. You have staff to pay, invoices are due. You have nothing liquid, not because your business failed, not because you made a bad investment, because you kept your money in a bank, because that is what responsible people do. The businesses that collapsed in the weeks that followed were not failing businesses. They were businesses that had followed every rule. And this is the part that should stay with you. How was any of this legal? Where exactly did the authority to do this come from? That answer is the part that matters most. There is a concept most people have never encountered, even though it governs their savings directly. It is called a bail-in. And to understand it, you need to understand one legal fact that no bank has ever clearly explained to its customers. When you deposit money, you believe you are storing it. The law says something different. The law says you have lent it. Your deposit is legally a loan made to the bank. The bank owes you the balance, but it has already deployed that money into loans, investments, and instruments that cannot be liquidated instantly. You are not a customer storing property in a vault. You are an unsecured creditor. And in an insolvency, unsecured creditors receive whatever remains after everyone with higher legal priority has been paid. Your money is not stored, it is lent. A bailout, what happened across the United States and Europe in 2008, uses public money to rescue the failing institution. Depositors are protected. Shareholders lose value, but ordinary account holders keep their balances. The taxpayer absorbs the cost. It is expensive and politically unpopular, but the depositor is not touched. A bail-in flips this logic entirely. The rescue comes from inside the institution itself. Shareholders are wiped out first. Bondholders absorb losses next. And if that is still not enough, if the hole is large enough, depositors are next in line, not through confiscation, through a legal conversion of what was always, technically, a creditor claim. The depositor becomes an involuntary investor in the recovery of an institution they never chose to invest in. They did not agree to this risk. They were never told they carried it. But it is written into the terms of every standard bank account in most developed countries. It has been there for decades. Cyprus did not invent this mechanism. Cyprus demonstrated it at scale, in public, inside the European Union. And then the EU took that demonstration and wrote it into permanent law for every member state. But this is not where the pattern ends. In 2014, the European Union passed the Bank Recovery and Resolution Directive, the BRRD. This directive formalized the bail-in framework across all member states. It established exactly when and how deposits could be used to recapitalize a failing bank. The language is technical, the documents are long, but the logic underneath is simple. If a bank is failing and public money is unavailable or insufficient, the institution can be rescued using the funds of its own depositors. The deposit guarantee in EU countries covers accounts up to 100,000 euros. Above that threshold, the protection disappears entirely. Below it, the guarantee is only as strong as the fund that backs it. In Cyprus, at the time of the crisis, that fund held enough to cover approximately 3% of all insured deposits. 3%. The promise existed. The resources to keep it did not. But Cyprus was not the beginning. It was the most visible, recent example of something governments have done in different forms across different decades. And the pattern reveals something the individual event does not. In Brazil in 1990, President Fernando Collor froze 80% of all private savings accounts in a single overnight decision. The stated reason was hyperinflation spiraling out of control. Accounts above a small threshold were locked for 18 months. Businesses arrived at work unable to reach their own operating capital. Families could not pay for medical emergencies. Suppliers went unpaid. Contracts collapsed. The money was not taken, it was frozen. But for the business owner who needed funds on a Tuesday morning, frozen money and absent money produce exactly the same outcome. In Yugoslavia, in the early 1990s, ordinary citizens had saved in German marks, hard foreign currency, held specifically because it could not be devalued the way local currency could. These accounts were blocked by the government. The foreign reserves were needed to manage the collapsing economy. The accounts were frozen, the reserves were deployed, and when the funds were eventually released, they were returned in local currency that had lost the vast majority of its purchasing power. The deposit came back. The value it represented did not. In Russia in 1998, the government defaulted on its domestic debt, and the ruble lost more than 70% of its value within weeks. Banks that had invested heavily in government bonds became insolvent almost overnight. Withdrawals were suspended across the sector. During the weeks that banks remained closed, money existed on paper and nowhere else. The numbers in the accounts were still correct. The accounts were simply not accessible. People who had saved carefully, who had done nothing wrong, discovered that the gap between owning a number and holding something real could open without warning and close around everything they had. Brazil, Yugoslavia, Russia, Cyprus, different decades, different governments, different stated emergencies. The sequence is identical every time. The system faces a crisis it cannot resolve with available resources. The money exists inside the banks. The rules change. The depositor finds out last. This was not an exception. It was a blueprint. The deeper issue is not any specific event. It is the architecture that makes every one of these events structurally possible and structurally repeatable. Modern banking is built on a legal reality that almost no depositor has ever been clearly told. The bank owes you your balance, but it does not hold your balance. It has already deployed it into mortgages, corporate loans, government bonds, financial instruments that take time to unwind. If every depositor demanded their money simultaneously, no bank in the world could return it. Not one. This is not a flaw in the design. It is the design. It has operated this way for more than 3 centuries. It works as long as confidence holds. As long as people believe the number on the screen means something real is waiting for them. The moment that confidence breaks at scale, quickly, in a system already under stress, the invisible structure becomes the only structure that matters. And the people who decide when that moment has arrived, when a bail-in is necessary, when the weekend window closes, are not accountable to depositors. They operate under institutional pressures, political timelines, and legal frameworks that were designed long before any individual crisis made them visible. What you see on the screen is not what you control. The man at the ATM in Nicosia did not make a mistake. He saved. He paid his taxes every year. He kept his money in a regulated, insured, supervised financial institution. He did everything the system asked of him. And then the system changed what it was asking quietly on a Friday night, in a meeting he was not invited to, using a legal framework built specifically for exactly this kind of situation. His money was not stolen. No one moved it to an offshore account. What happened is harder to describe than theft, and in some ways harder to process. The definition of what he owned was quietly changed. The account still showed a number. The number still had his name on it. But what that number actually meant, the access, the usability, the real-world value of it, had been restructured without his knowledge, without his consent, and without any mechanism for him to object. That is not a failure of the system. That is the system functioning exactly as designed. Right now, the bail-in framework is active law across the European Union, written into the BRRD and applicable in every member state. Similar provisions exist in the United States under the Dodd-Frank Act. In the United Kingdom, in Canada, the specific thresholds differ. The triggering conditions differ. But the underlying logic is the same everywhere. If an institution requires rescue and public money is not available or not sufficient, the funds can come from inside, from the deposits, from the accounts that appear perfectly safe because the number on the screen has not changed. Most people will never experience this. Most banks will not fail. But the condition that makes it possible, the legal classification of deposits as loans rather than property, is not a temporary emergency measure created in response to a crisis. It is the permanent structure of the system. It was there before Cyprus. It is there now. It will be there the next time a government sits down on a Friday night to solve a problem it cannot solve any other way. Here is what almost no coverage of Cyprus ever mentioned. The ATM withdrawal limits were adjusted before the parliamentary vote, before any public announcement. The machines were managed on Friday night. The parliament voted on Saturday. The public found out when they tried to withdraw. The decision came first. The explanation came after. That was not an accident. It was a sequence. And the people making that decision were not protecting depositors. They were protecting the system. Your savings account is not a vault. It is a promise. And a promise is only as strong as the conditions that make keeping it possible. If that decision were made tonight, in a room you are not part of, on a timeline you cannot see, what would you actually hold in your hands by morning? Not the number on the screen, not the promise in the terms and conditions. What would you actually have?